Today we are talking to Philip Parker, Founder and Chief Investment Officer of Parker Asset Management. Philip has 25 years of experience in the investment game, and he runs the $30 million Parker Enhanced Leaders Trust, which has had a stellar year to February. It has returned 4.8% for investors, even as the market has plummeted about 6.5%. Now, Philip is here to tell us how he did it. So, Philip, thank you very much for joining us.
Thanks for having me, Patrick. Yeah.
Just to begin with, can you start with your investment philosophy, please?
Yeah, so the investment philosophy sounds a little trite, but it's to make money in all sorts of markets. And doing that, we use a combination of value and growth-oriented strategies. And we also believe that you have to be nimble in markets and not just sit there and watch things fall when you know that there's bad news coming or you're in the middle of a down cycle. So you're happy to go to cash. We're happy to protect a portfolio using options. So generally we feel we like to cover all areas but make money for our clients. We like it when things are getting sold off and we can buy stuff at a discount to what we view as sort of fair value. But we still think something's around the corner for Europe, and it's typically going to involve Spain and Portugal rather than, Greece is obviously, going pretty much over there. So we, as I said, we put some money to work. A couple of mining support companies that have done very well for us. Boart Longyear was one of them. We've also put some money into some oil and gas players. Producing oil. We're still buying some of those companies, so we're not at liberty to disclose the names. But they make sense, and we've Tim Reardon, who works with me, has spent many months researching and visiting these companies, and we think there's a really interesting story to tell in the oil and gas sector. We concentrate our effort in mining support, oil and gas sector, resources. We have a consultant geologist who we use the whole time to go and have a look at interesting prospects that we find or existing businesses that we like.
A US dollar ETF, which is open to anybody. Anyone can invest in it. What's your thinking behind that? We have made 3 big trades in the US dollar ETF last year for the calendar. I'm talking calendar year to December 2011, and we made 30% return. On roughly 10% of the portfolio. So significant gains from that trading. We've re-entered the US dollar position as the currency crested over 107. So what we're doing simply is buying US dollars, selling Aussie dollars within that fund. We've seen it fall back to 104, 103, and we believe in the short run that should fall back towards par. In the longer term, and now this is just my own personal view, I think for Australia to remain competitive, we need to see that currency lower, around the sort of 80 to 85 cent mark. It's essentially a bet on the Australian dollar weakening.
Yeah, absolutely. Okay. Absolutely. So, and just to follow up on that, we think that commodity prices are peaking out. Why are we doing it? So the thinking behind it, the macro thinking is China is slowing down. There's no doubt about it. We have very good contacts there. We're anticipating 7% GDP growth rather than 8s and 9s over the next calendar year. And we don't think long-term commodity prices are sustainable at these sorts of levels. And the other reason, of course, is supply. Supply is going to kick in.
How do you decide I'm going to put in X% of my fund into a US dollar? How does that fit into your overall process?
Yeah, very, very simple. We have a basic overlay where we say, we're an Australian fund, therefore we should have Australian investments in that fund. Roughly 60% of our investments on any given day will be if we're fully invested, which we're not at the moment. But if we were, roughly 60% would be in stocks out of that top 50 area, but selective. So we don't just buy all of them. At the moment we have Coca-Cola and Woolworths in there out of the top 50, and that's pretty much it. And then the other 40%, we have a great rule. We can do anything. Absolutely anything, as long as we have stress tested, made sure that we're not just doing a knee-jerk trade for the sake of it. We've thought about all the implications of that transaction as physically possible. Our view is, it's really important to make money for clients year in, year out, and especially in the down market. So good stock selection, being able to move into cash when you feel it's appropriate, and then also having an overlay of option protection gives you the downside, and that's where you make the money. If you make the money in the downside, the upside will look after itself. So we're trying to encourage financial planners to look at us and say, yeah, these guys are different. and all they're really caring about is the client's money every day.
So what's the best way to protect your portfolio against volatility?
Going to cash quickly and using options to protect the downside. It's interesting, we've averaged 17% each year for the last 3 years, right up to we sit here today, compound. And we've done that at roughly 20% lower volatility or risk than the ASX 200 itself. So we've made an outperformance, but we've done it with less risk. The key is being able to protect stuff on the downside. That's the key.
I did want to ask you, if you were given $100,000 now, a windfall of $100,000, you weren't allowed to invest in your own fund, so you can't cheat there. Where would you be putting it?
So at the moment, we're investing in a company called Forge Group. They're an engineering, procurement, build business in the engineering sector in Western Australia. We really like the management. In fact, we had a meeting with them last week, one-on-one. Peter Hutchins is the man running the show there, and he's a highly astute person, and we respect his management style. And they've got a joint venture with Clough, which is working very well for them, and they've just bought a business in January called CTEC, and basically that business that they acquired, all up including key performance indicators, if they work, they'll have to pay the previous management $38 million. They've received $600 million worth of contracts on their books over the next 3 years, probably 2.5 years, but let's be conservative and say $600 million of work. Yeah, it's a phenomenal deal. It's taken their, well, by being smart investors and finding a business that they bought on a very cheap multiple, less than their own multiple, so quite accretive to their returns.
It doesn't worry you that maybe there's something wrong with this business?
No. We've had a good look at it, and we've spent, Tim and I have spent a lot of time looking at the guys. We've invested in Forge since late 2010, so we know them very well. And no, we're very, very comfortable with it. It brings them a whole suite of electrical expertise that they're really very interested in. So 100,000 now, I'd put it into that. But obviously, that'd be risky to do that in all one hit. But if you're within the fund, or if within a personal portfolio, and if it was a big portfolio, I'd certainly be looking at doing that. Yeah.
I always think of shale gas as being a US phenomenon.
No, it's definitely happening in Australia, more particularly South Australia and Queensland. You're seeing it in America. They're doing that in the States. So we're very keen on that sector locally. We think there's a lot of wealth to be made for Australia in that sector. The LNG assets off the coast, which we've made a lot of money out through Woodside over the last 20 years of investing. I've always been a great believer in Woodside. We were all aware that come 2020, unless there's substantial investment into that area again, it's going to, the ballpark's going to change. To find more LNG out there, it's a huge expense, massive. And you see Shell wanting to back out of Woodside. So I think it's just logical that people are looking onshore more, and that's what we're spending a lot of time looking at.
What's the next big thing?
Well, for us, that is the next big thing, that whole sector. So these are companies that are they're down the food chain, and we've done a lot of proprietorial work on it, and we're pretty happy with that sector. I think there'll be some big volatility, definitely. In fact, I don't think it's going to go on at the same rate. I mean, 3 of those stocks have risen by 70% in the last quarter. So that won't last. But at the end of the day, if you're looking for something as a larger cap stock that is an investment that we're making now as well, just to give you another one, in the last 3 to 4 months, we've done extremely well out of ResMed. In the 90s, you were paying much higher multiples for it than you are now. So that's telling you that people think that it's slowing down, but I would argue the opposite. I think that the business is actually growing. And the reason I think it's growing is simple. They're doing some studies. There's a big medical study going on in Argentina at the moment that is showing, and they're not part of it, they're not funding it, that is showing that people who have been on sleep respirators are actually having a reduced incidence of heart and coronary disease issues. I actually think they've got this opportunity to broaden from just dealing with sleep doctors, respiratory surgeons and sleep doctors and GPs. I think they've got I think there's a heart issue that they can help with, and there's a diabetes issue that they can help with, and they're 2 of the big growing diseases worldwide.
Philip Parker, thank you very much for joining us.
Thank you.